Good morning and welcome to the second lesson or episode where we try to learn how to trade the stock market, the forex market, the markets overall, and try to make ends meet. In this episode, in this lesson, we will be covering gaps or inefficiencies in the markets. I know that there's about 6 or 7 of them that I personally use, but I decided to boil it down to these 3 different types of gaps, and you would notice that I actually use about 1 or 2 of them overall, so there was no need for me to give the whole list or the whole arsenal for the sake of profitability, because the sake of this series is to try and make ends meet. So the 3 of them that I'll be looking at are these. The first one is a volume imbalance, second one is a liquidity void, and the third one is a fair value gap. A volume imbalance is essentially when we have a candlestick, we have price printing, and we trade higher from there or lower from there, but in between the bodies of the candle, in between the bodies of the candle, we only have wicks somewhere there or somewhere there. And I think this will be better illustrated with an image. So let's paste in an image. So it would look something like this. Notice how we have a bearish candle there and a bearish candle there. We have a bullish candle there. And I know it might not look the best right now, but trust me, it's going to make more sense as we go deeper into this. So we have a bearish candle there and a bearish candle there. Notice that in between these 2 candles, the only thing we see are wicks. So notice there's a tail there and there's a wick there, or a bottom wick and a top wick. So we have this area where there is no body of a candlestick laying over it. This is a volume imbalance. This is when you know that price is likely going to get attracted to this area to support it higher or lower, depending on whether we have a bearish one or a bullish one. And I'm going to try my best to explain it better with real examples on the charts. So just keep in mind that the space between 2 candlesticks where the body of a candlestick is not there, by a body I mean this solid white area or this solid purple candle. Notice this one doesn't have any tail or wicks. It's just one body, one massive body. So in the same way, this area in between these 2 price action, in between these 2 candles is inefficient, in a sense that there's liquidity, but there's volume, but there's no solid orders placed in this area. So this is an inefficiency called a volume imbalance. The next one we have is a liquidity void, and let me see if I can find one. And this is basically a liquidity void. Well, literally it is just a void in liquidity. There's nothing, there's no price action at all. But I know this might not make any sense, because if there's nothing at all, then what are we trading? Well, let's see if we can paste something in there like this. This is we can see the candle is printing. We made a top wick, we went lower, and then we opened up here. So now you ask yourself, how did we trade higher and somehow jump from closing here? Well, this was a bearish candle, so we did close there at the low, then popped open up again here. So obviously there's no liquidity at all. That's why it's called a liquidity void. It's void of any liquidity whatsoever. There's no tail, there's no wick, there's no body of a candle. It's an actual space or void in price. So this one is easy to identify because it's literally just what it says it is. It's a liquidity void. It's void of liquidity. So this is the second type of inefficiency that we will be using to trade. Then the last type of inefficiency is one that you're going to probably hear me say the most. It's called a fair value gap. A fair value gap is basically formed when we move so quickly from one area to another that, because this is called an impulsive leg, a speedy move to the upside, to the point that we actually create a space in between the high of the previous candle. There's a body that lays over here, and then a low of the next candle. Let's see if we can find an example on the chart. I know this is a bullish example, but we also have the same with the bearish side. But I think this piece of the markets is enough to show what I want to show. So notice here we displaced lower, and then notice how price went back up, then down, then up, then down. Notice how every time we open up here, while reading candles, which we're probably going to do on our next episode, we're going to learn market structure shifts and everything. But notice here, we opened up there, we went higher, we closed there, then we opened again, traded higher, went low, went this low actually, then came back again just to close here, opened up again, went lower, went higher, closed up there, opened up, went higher, went lower, closed over there. We did the same until this point. We opened up there, we traded lower, we traded higher, came back, opened up there. So already we can identify one of the gaps that we just talked about now. For those that want to give it a try, what would this gap be? Notice that we opened up there, traded lower, then went high and closed here. But somehow we didn't open the next candle here. We opened the next candle there. So what type of gap would you say this is? I'll give you just a few seconds. And I hope you said that this is a volume imbalance, because there is trading that happened in between, but we only had wicks. We had a wick there and we had a wick there. Of course, I could zoom in even more, but I think we can all see that there is only a wick between these two candles. So that's a volume imbalance. So anyway, opened up here, traded lower, and then went high, came down, opened there, lower, then high again. So notice what happened here. We went up so quickly to the upside that we actually created a space. This is a fair value gap. We created a space in between the high of this candle and the low of that candle. So whenever you see me mention a bullish fair value gap or a buy side imbalance, sell side inefficiency, I'm basically talking about a bullish fair value gap or a fair value gap that moves to the upside. It went so quickly to the upside that we need price to give us fair value, to provide fair value to the market and trade back into that inefficiency. It doesn't have to do so all the time, but it is something that draws price. So notice the same way that we talked about liquidity the last time, where we say that price just moves from one level of liquidity to another level of liquidity, clearing buy side and sell side liquidity all the time, which is what all price does, from buy to sells, to buy to sells, and just keeps going in one huge range. In the same way, price also moves from gap to gap to gap. We find price moving from fair value gaps to liquidity voids, to volume imbalances, to any inefficiency that there might be in the market. Notice, in the same way that we have a bullish fair value gap here, when price was falling off again to take maybe this swing low, this liquidity here, went quickly to go take that liquidity. We went so fast to the downside that we actually created fair value gaps. We have one from this candlestick's low to that candlestick's high. That's a bearish fair value gap. We also have another one here from this candlestick's low to that candlestick's high. That's a bearish fair value gap. So price is likely going to draw back to it. And if you wanted to see what chart it is, this is actually the DXY chart from the 1 hour perspective right there. And notice how price came and traded back into it, into this inefficiency. That's why you find me drawing out my inefficiencies like this, with a rectangle tool. So notice price came back into it. And then here we actually see another type of gap, which is a liquidity void. We closed here and opened up way up there. So I personally will be paying attention to this gap as well. Let's just draw this out with a line like that and see if it could draw price in the future. Notice when we're going up, we created fair value gaps as well. We created a BC there, we created a BC there, and we went and finally took this buy side liquidity. This is a liquidity that was swept eventually. But let's see if price is going to come to this liquidity void, because liquidity voids are the highest draw, the strongest draw on liquidity, then volume imbalances before fair value gaps. But fair value gaps are the easiest to identify, and you don't even need these two, to be honest with you. As long as you can identify a fair value gap, you will be able to make ends meet with this series that I'm teaching now. So pay more attention to spotting a fair value gap. And notice eventually price came down, tapped it, and look how quickly price ran away from it. Immediately we touched this liquidity void, showing you that it's a very strong PD array, it's a very strong premium discount array, it's a very strong springboard or drawn liquidity, if you want to call it that. So price came aggressively to it and ran quickly away from it as well. And notice when we're running quickly, what did we create? With speed comes fair value gaps. So we created a fair value gap there, a buy side imbalance or a BC. And notice how we came down back into that BC and ran up again, continued running to the upside from there all the way up, taking more liquidities on a higher time frame. So this is something to definitely keep in mind. Of course, here it's a different day, this was a different news event. Different things happened and price came back down into that same liquidity void. We now filled it up. Notice before we had no trading whatsoever in between this price, right? This price meaning 105.672 and 105.648. We had no body of a candlestick in between here. At this point, we had the wicks now, but we still didn't have the body of a candlestick. And then eventually, finally, here we laid over a full body of a candlestick. Now, only now that I can decide to stop paying attention to that volume imbalance or liquidity void. But notice we created another one here and price came, closed it off with this body of a candle and continued lower. We created another one here, price came, used it as resistance and pushed lower, used it as some sort of a ceiling. We can actually call this entire space a liquidity void. Why can we call it a liquidity void? I mean, a volume imbalance, not a liquidity void. We can call it a volume imbalance because the body of a candle does not lay over anywhere in this price, in this space. So it's probably something we're going to refer to at some point in the future. We do have wicks, but we don't have a body of a candle. So we'll keep an eye out on that. We did the same thing here. Notice we created a liquidity void right there. There was no trading at all, but the next candle came and laid over it, so this finished it off. But if you didn't ignore it, notice we came again to it. We tapped it the same way we tapped the other one and quickly ran to the upside, creating a fair value gap. And now notice that volume imbalance that we said we needed the bodies to lay a body of a candle to lay over it. Now we have a body laying over that candle, so we could possibly see price come down to this and use it to reject for higher prices. So that is an explanation, a very brief one, on the three main types of gaps that we have in the markets. Going in the next episode, we will try and merge both of those concepts together of liquidity from the previous episode and gaps from this episode, and then try and read candles with that, with closures and no closures, because how do we know when price is likely to go to one gap and not the other one? So that's something we will cover in the next episode. For now, I hope this was insightful, Stay safe, good luck, and good trading.